Imagine if I told you that the biggest cryptocurrency exchange in the world has finished using all of its XRP. Impressive, isn't it? However, that is correct. Silently, Binance has lost billions of XRP and nobody seems to care. I kept looking into it because I could not let this pass. According to what I uncovered, the XRP market is being secretly cornered by billion-dollar institutions as well as panicked traders. Watching this until the end will shed light on why XRP has suddenly become one of the world's most inefficient digital assets, as well as what this development could signify for its price and for those of us who have it. Before we delve any further, a brief observation. I have a strategy for the XRP millionaire. If you are interested in seeing where the top 1% of XRP investors are at the moment, it dissects the methods used by the biggest proprietors to plan for the future before the next big step. How they build up, strengthen, and multiply their positions. Obtain it immediately under this video in the pinned comment. You can find it. Great. Now, let's start working. Nothing went right when I inadvertently checked on-chain's data a few nights ago, just like any crypto nerd would do. The biggest cryptocurrency exchange in the world, Binance, did in fact see a decrease in their XRP holdings, a genuine drop, not a microscopic one. The data was unfalsifiable. As of late, Binance's XRP reserves were at 2.74 billion XRP. This is the point. Even though it seems like a large amount, their balance sheet contained more than 3 billion XRP a few weeks ago. Without any major statement, fanfare, or news coverage, almost 281 million XRP, worth more than $736 million, vanished from Binance's accounts in a matter of days. While all eyes are on the price charts, picture someone stealthily emptying their vault. There is no mistaking the current situation. Even a graphic demonstrating that Binance's XRP reserves have hit a new yearly low is available. They weren't this powerful until around the middle of the year 2024. Something major is about to happen when the biggest exchange on the planet starts to pull out its top asset like XRP. So now I'm curious about the source of all this XRP activity. When is the best time? There is almost never an accident while there are hundreds of millions of tokens remaining in the exchange. It goes without saying that Binance wasn't alone. Another major Asian exchange, Upbit of South Korea, saw its XRP reserves drop from 6.12 billion to 6.08 billion. These tokens worth almost $15 million vanished in the span of a single night. Coinbase, which has just reinstalled XRP, has reduced its holdings of all of its tokens to 32 million XRP, a decrease of 96%. This is essentially just a shelf without any products for Coinbase. Now, tell me what's happening. People aren't really animated when they aren't afraid or self-assured. The more I examined it, though, the clearer it became. There should be no alarm. Here we have positioning. Do not leave an asset on the exchange if you are a long-term investor who believes in its potential. They manage it by transferring it to secure locations like cold storage, hardware wallets, and individual savings accounts. This is supported by blockchain data as well. The amount being withheld is substantial. A wave is this. The transfer of funds from exchanges to individual wallets is happening at a rapid pace. Something is implied by this. Solid bodies are congregating, and I'll tell you why this matters. Supply and demand. After a token is removed from the exchange, it is no longer available for purchase. Less and less trade stock is available. Consequently, the impact can be tremendous when demand surges, which it inevitably does. Look at it like a musical chair. As time goes on, the music fades out, and the number of available chairs decreases. Products don't merely increase in price when demand outstrips supply. When new consumers flood the market, their ceiling is the sky. This is not a little influx either. Whales can be found in every ocean. What's going on behind the scenes? Let's discuss it. There is an invasive split in these on-chain data points. Following a brief price spike, a number of medium-sized XRP whales, those with 110 million XRP in their possession, recently sold over 140 million XRP. XRP's value increased from 236 to 263, an 11% increase, and they made a profit. Although it appears gloomy at first glance, this is really only a rotation. Traders are making trades. This is their current action, even when a few medium-sized whales were selling at a loss. Record numbers of corporations were buying, which makes for a far more intriguing overall picture. I was just hit by one of those. Evernorth Digital Asset Management is the name of the company. They launched a massive AOT tag surrounding XRP out of the blue. The value of Evernorth's XRP holdings dropped from around $100 million to nearly $389 million in just a few days. Nearly $1 billion worth of XRP has been blocked. It was a watershed moment in XRP's evolution. The action begins to heat up now. The biggest two-day clean XRP outflow from the exchange occurred between October 19th and 20th according to the blockchain. Within a day, around $2.6 billion worth of XRP was removed. There is no fragmentation in this trade. This is the world of large-scale trading. At that point, Evernorth bought it. The stars are aligning just so. It's as if a massive whale suddenly flung a net over the exchange and caught a huge amount of XRP. Now, if you're an experienced Bitcoin trader, you probably already know what this kind of behavior usually means. An enormous outflow, then savings for the future. This structure is bullish since UOL fixes XRP instead of reselling it when they withdraw it from the exchange. This is historically one of the best indicators that big money expects future rates to be higher. The consistency we observed before was echoed throughout this entire situation. Similar events occurred in 220D prior to the significant increase in Ethereum's market capitalization in 2021. The pattern keeps happening: amassing, depletion, and subsequently growth. The system rights itself when the number of offers and demands increases. Additionally, the rate of decrease in the XRP supply curve is unprecedented. The reserves of Binance have hit an all-time low. Almost no one is using Coinbase. Billions are being loaded by Evernorth. Blockchain technology never lied. A lot of sensible money is moving quickly. Now things start to become interesting. Not all experts think this is a coincidental buildup, presumably linked to the next major ripple, collaboration, or the extension of the global corridor. They see this as a coordinated positioning in anticipation of the liquidity event. If that's the case, then now is the most considerate moment to take out some cash. Reducing the available free volume is the first step in requesting new liquidity. This is the process of constructing a formal institution. The same pattern emerged in multiple areas as I persisted in following the data. Money from the exchange flowed in a synchronized fashion across Asia, Europe, and North America. It's as if all the major shareholders have suddenly decided that the exchanges don't own XRP anymore. It is a vault item. Consider the implications of this today. A market that is prepared to shock the supply as the result of a number of factors, including a decrease in supply, purchases by institutions, and a dispersed community that discreetly holds on to its assets. These circumstances will pass in the event of a fresh influx of capital, whether through exchange-traded funds, ETFs, worldwide payment integration, or some other means. There will insufficient XRP to calm the storm. Plus, this isn't some abstract notion. What is happening right now is being watched by us. In other words, blockchain technology serves as evidence. Though it is typically silent just before a shift, the amount of XRP proposal floating about the exchange has never been low. However, the fact that I did not continue beyond this point did not satisfy me. At this very moment, I would like to know why. What causes the simultaneous convergence of so many organizations, owners with different interests, whales, and institutions? At that moment, I stumbled onto something that further connects these ideas. As it turns out, the solution lay elsewhere than in straightforward market cycles or price movement alone. The key is to be well prepared and give yourself plenty of time. I noticed something as I dug further into the on-chain streams. The rate of these withdrawals started to rise at about the same time that Ripple started making subtle but important changes to its institutional payment mechanisms. In instance, XRP has requested technologies that integrate liquidity with conventional finance. Take a moment to consider it. At the same time as Ripple is improving its infrastructure for worldwide customers, Evernote is charging billions of dollars and Binance's XRP balances are plummeting, as if the whole ecology had been secretly getting ready for the next phase all along. This is where my impressions were most heightened. Liquidity providers must first fund or supply XRP whenever Ripple enters a new corridor, be it in the Asia-Pacific, Latin American, or Middle Eastern region. Tokens are removed from exchange books not because traders sell them, but because institutional users are unable to use them. Right now, we can see this as the beginning of the liquidity reorientation process, which will eventually lead to something big. The proof of this is all over the place. Over the past few months, Ripple's collaboration with local banks, fintechs, and state payment systems has skyrocketed. Actually, XRP speed, the rate at which tokens flow throughout the chain, has decelerated in the background. There will be more long-term maintenance, fewer agreements, and fewer transactions. Like in earlier waves of network advantages, this is a reflection. This section is crucial for grasping the situation. So, let's circle back a bit and discuss psychology. A lot of small-scale investors think that when tokens leave the market, it's because people are scared. Actually, though, things work backwards. Those who are most certain of their abilities and who can see ahead of time assume command. They move forward without seeking confirmation. They stand far away. Smart money differs from reactionary money in this respect. As long as other people are the focus, smart money may be amassed invisibly. Speculative investments are made once news reports confirm what many suspected, that the blockchain had been visible weeks earlier. I'm not claiming that tomorrow is the day of change, but I am stating this. Everything about the XRP chain's flow pattern suggests that we are in the early stages of implementing a bigger liquidity cycle. Moreover, this does not occur on a monthly basis. What intrigues me the most is how much it makes me think of 2017. So the value of XRP remained constant forever. It remained motionless as market data yelled out its movements. Everyone assumed the market was dormant as hammers consolidated and balances fled the exchange. Suddenly, though, something happened. It wasn't simply a movement. XRP went boom. The structure appears familiar, even if the current conditions are clearly more developed. The shifting locations of flea markets is another new anomaly. These addresses have been inactive for almost 5 years and have not transferred any XRP. They awoke out of nowhere. Now we get to the intriguing part. Sales are low. They do a restocking and multiple additional flea marketplaces. As a precaution or to set oneself up for future foreign exchange transfers, this is a common practice. They restructure their assets instead of just tossing them on exchanges. It is common practice to do this prior to significant savings events or agreements. One of the most notable changes this year in terms of savings is Ripple's choice to save the corporate level from Ripple Prime and Medicico. Financial institutions and even sovereign funds can use these systems to store and oversee digital assets like XRP. Meanwhile, did you hear? According to on-chain research, some of the XRP that leaves the exchange makes it to these new savings rails. This is not a collection of broken diamonds that has a few thousand XRP here and there. These mass transfers are structured. Institutional thresholds are represented by the amounts, and savings institutions are represented by the addresses. This happens for a reason. Here we have adaptability. Get out of here and examine the broader view. Institutional infrastructure replaces fragmented trading as the dominant model in the XRP ecosystem. In the past, exchanges were the primary means of obtaining liquidity, but now it's not. At the moment, it's corporate treasury bonds, liquidity centers, and private savings. As a digital asset moves away from speculative liquidity and toward utility-controlled liquidity, it goes from being just another coin to being an essential part of the financial system. The magnitude of Binance's withdrawal and the details of Ripple's infrastructure renewal made it crystal clear that the situation is not one of complete anarchy, as they indicated. Fragmentation of trade suggests. I am describing liquidity movement. An essential piece of the puzzle is this detail. Several Middle Eastern payment channels started to show unusual account activity in mid-October, right before the largest XRP outflow. Although XRP-denominated transactions grew, exchange balances decreased. Somehow this is achievable. Why? Because the processing of liquidity took place outside of the exchange. This is how institutional use is defined. Consider it in this light. Customers of Ripple do not purchase XRP on Binance or Coinbase when making a money transfer. Market makers and branches outside of the exchange are the ones who bring it to them directly. This allows these branches to take XRP out of the exchange, hold on to it, and then utilize it as liquidity between themselves. What is the outcome? The demise of exchanges gives the impression that coins are leaving the ecosystem altogether, while in reality they are just moving to a different layer, where they can be utilized for actual payments. What the majority of traders fail to notice is this. Maintaining an enduring presence on exchanges has never been XRP's intended objective. Real money flows, institutional networks, and account rails were all intended to accommodate its passage through them. Put this together with the shift in mentality that is happening right now. Nowadays, small-scale owners take more time to reinvest their profits. They hold on to it, wager on it, and then put it in cold storage. Positions are attached to institutions for the long haul. Exchanges are experiencing a depletion of their resources. The outcome is a market that is prepared to contract in response to an uptick in demand, less liquidity, and less sales pressure. Regarding demand, one aspect has not been affected as of yet: data tokenization. The idea of a system for tokenized assets was heavily touted by Ripple. The whole spectrum of digital currencies issued by central banks from real estate to CBDCs. As an independent asset, XRP supplies the liquidity bridges needed by each of these use cases. Therefore, XRP will be put to use rather than merely traded once this technology is introduced on a big scale. The distinction between transformation and speculation is this. We do not anticipate any unrest with XRP. It becomes a part of the foundation for future financial resources. These monetary effects are where the mechanics really start to shine. So let's dive into them. Now, a precipitous decline in stock prices does not always lead to an instant uptick in value, but it does generate market excitement. As time goes on, this energy builds up, and even a small influx of buyers reduces the supply of available offers. This causes prices to rise sharply and rapidly. Right now, this is occurring precisely. For the first time in more than a year, the XRP Binance balance is below zero. Almost no one is using Coinbase. Exchanges in South Korea are keeping an eye out for a consistent outflow. Diamonds held by institutions are on the rise. All systems are prepared. However, the majority of individuals failed to notice this. The general liquidity proposition XRP, which is heavily traded, has already dropped below its 2021 growth levels. This indicates that compared to the height of the past bullish cycle, there is currently a lower supply of XRP for trading. Let that sink in. The market has become more concentrated, volatile, and acute. But infrastructure and acceptance are far stronger. As you may recall from your studies of past market models, there is typically some lag time between the announcement of a price cut and the subsequent response. Preparing for a big wave involves keeping an eye out for an outflow. When a wave is imminent, not if it will occur, is the real question. XRP Binance team, meantime, is getting ever more strategic with their actions. Before XRP is ready to be used on XRP Binance, several people make automated dividend distributions by storing it in various chains. Some people deal with liquidity providers through private agreements that are never listed on any public market. With each iteration, the obvious proposition shrinks even further. If you've been keeping up with this sector for any length of time, you're aware that XRP's driving factor has always been its hidden workings. As usual, the blockchain is always ahead of the news. The blockchain is the first to tell the narrative. The themes of accumulation, migration, and readiness are now front and center in this narrative. This, in my opinion, is a crucial conclusion. You should not be alarmed by these withdrawals of funds. They indicate something, an indicator that the ecosystem is developing into its full potential. speculative trades, and the practical use of corporate and institutional infrastructure both make up the landscape of liquidity. Consequently, I do not perceive a disappearance when I observe the XRP balances moving from Binance to non-exchange quantities. I perceive a change. A network is getting ready to activate in a stealthy, calculated fashion according to my observations. And this curve is just starting out for the reason that something much larger was taking shape as revealed by the statistics. We are witnessing an unprecedented influx of hitherto unseen enterprises into the XRP ecosystem. These new organizations aren't your run-of-the-mill crypto firms either. Regional payment centers, private clearing houses, and sovereign funds all fall within this category. Businesses that adhere to strict protocols and never deal with assets that haven't been inspected, regulated, and scaled. Moreover, they are now invisibly entering the XRP ecosystem. A financial consultation is not what this is. Permit us to examine this with more precision. Now, some miners linked to depository savings, who had previously had no dealings with Ripple, started receiving XRP incoming orders in the past 2 months. According to data from the institutional monitoring panels, these orders are too big for the degree of detail. Regarding orders organized by parties that correspond to institutional adoption, it's around tens of millions of XRP. In what ways does this matter? Reason being, it represents a step toward the subsequent activation of institutions. These groups are not betting on a temporary increase in value. As a foundation for their accountancy, they have decided to adopt XRP. The liquidity cycle covered in parts 1 and 2 becomes something far stronger than a permanent demand basis once this level is reached. Consider it from this angle. When a new bank or payment provider partners with Ripple, they do more than simply purchase XRP. It guards, distributes, and cycles liquidity through the corridors. If there is no trading activity, this XRP will not be reintroduced to the market. Put simply, the supply is decreased with each joining. The available free volume of XRP gets progressively smaller as this process is repeated, corridor by corridor and region by area. At this point, it becomes impossible to disentangle the dots any longer. The Ripple roadmap for 2026 started to show up at the same time these institutional dots started to light up. Additionally, the activation times of these dots precisely correspond to a number of partners that were involved. Central banks, fintech clearing houses, and international accounts all work together in this CBDC research of bridge currencies for regional compatibility. In many ways, it resembles the real-time implementation of a digital system. Ripple waits to make an announcement. Until the rails are either completely down or won't be back up for a while. They had always planned this way, constructing first, then unveiling. This leads us to our primary comprehension. As more businesses sign on with Ripple or its liquidity centers, XRP will be required of them, completely necessary. Not optional, not hypothetical, but mandatory. Herein lies the Ripple model's latent brilliance. The AIO is not necessary for the asset. The rails themselves incorporate. This is the reasoning behind analysts' claims that XRP has the potential to transform from a speculative token into a valuable asset for money, real global transactions. XRP CBDCs, tokenized assets, will cause the demand for liquidity to arise, and the cycle will repeat itself. Monthly bars are not what these are. The dynamics at work here are monetary. This is where things start to get interesting. So, let's speak about time. This is happening just as global. Macro liquidity is about to rise again. This is the highest point of the strengthening cycle for central banks. Capital will seek for accounting methods with minimal competition and big profits as soon as rates begin to decline, and liquidity returns to riskier assets. And XRP stands out among digital assets because of its business structure and the transparency of its regulations. This arrangement for one of the most unequal risk-reward profiles in the whole crypto ecosystem is the result of combining these macroeconomic developments with the internal dynamics of the proposition that we examined. On the other hand, most people overlook a further level, engaging in conversation. Connectors are what Ripple specializes in, not only corridors. The fact that XRP will do more than just process payments, is due to Ripple's integration with ISO 2022 standards. Its collaboration with Interledger and its partnerships with tokenization networks, like the custodial package Medico. Blockchains, financial institutions, and DeFi ecosystems will all be able to share value through this. For this reason, the actions taken by these new institutions recently are crucial. In addition to storing XRP, they also set up channels. They check the conversion efficiency, accounting time, and throughput. A live system is built upon this. From once upon a time to soon, the story fits here. Some things are even hinted at by Ripple's leadership. A new liquidity model is born out of David Schwartz's recent revelation that Ripple can sell conditional deposit rights, not XRP per se, but rights to future releases. What this implies is that the current circulation concept won't be affected if institutions give XRP shares in the future. Huge financial actors may remedy the problem today with this elegant approach, ensuring market stability in the modern era. This is a basic move that changes the laws of the game, but only a few people in the cryptocurrency industry really grasp it. Preliminary estimates place the future XRP at the top of the global liquidity provider rankings. This has not been included into prices by the market just yet. Everything is interrelated here. Considering the new rights-based liquidity model, institutional storage flows, the withdrawal of funds from the exchange, and the expansion of Ripple's worldwide corridor, there's only one overarching story here. An outage cannot be generated via Ripple. The groundwork for the infrastructure is laid by them. The world's financial infrastructure is subtly being redesigned to favor XRP. All the while, everyone else is speculating about future prices. Where is the breakthrough? I get that some of you are thinking, actually, not even a single candle can be considered a breakthrough. An SU system is this. When Ripple's new corridors go live and this liquidity starts moving across multiple time bands in real time, XRP becomes something it has never been before. A worldwide accounting standard. Not guesswork, but integration is the end goal. Furthermore, the tips are now barely visible. They will be incorporated into the blockchain's data, which includes information on savings and testing of foreign payments. The pieces of the puzzle are getting leveled one by one. The argument is that infrastructure is being developed alongside the accumulation of the market. Everything is being prepared for activation. Additionally, this breakthrough will not be gradual as it passes. There will be no delay. It will be too late to invest inexpensively once it becomes clear, which is why those who understand what is happening today take a position before it happens. Follow the strategy of the XRP millionaire in the pinned comment below to obtain a comprehensive breakdown of how the top 1% of investors are currently placing themselves and the techniques they are employing to advance to the next stage of XRP. In order to comprehend the true financial structure of the future XRP, this is your comprehensive guide. Like and subscribe if you think this video is helpful.